Hello again from Sprott Money, sprottmoney.com. Guess what? It is time to wrap up the month of June, which means we're not only wrapping up the month, we're wrapping up the quarter, wrapping up the first half of the year. Yeah, we are already halfway done with 2024. They say time speeds up as you get older. I think we can all probably agree with that. So anyway, we're ready to wrap up the month of June. I'm your host, Craig Hemke. Joining us to wrap up the month of June is my friend Michael Oliver of Momentum Structural Analysis, somebody that Eric Sprott always speaks very highly of him and his work. So it's always good to hear from him directly. Michael, thank you for joining me.
Good to be back, Craig.
As we get going, just a reminder, again, Sprott Money is your company that provides all this great information. You always want to keep them in mind whenever you're in the market. And for now, the great kind of refer a friend program continues, where if you refer a friend to Sprott Money and they actually buy themselves some physical metal, you can save some big bucks on your next order. So go to sprottmoney.com, get the details. And of course, it's never a bad time to be adding physical metal. We're going to be talking about the metals with Michael here in just a second. But Michael, let's do two things real quick. Tell everybody a little bit about yourself, what your business is, and then we'll start to wrap up the month.
Well, since 1992, I got out of futures brokerage in the 70s and 80s and started research, technical research of a methodology I developed back in the 1980s. And so 92 to that's 32 years, okay? And mostly we'd sold our research to institutions, banks, hedge funds, mutual funds. And in 2000, late 15, we opened up to retail subscribers. But what we cover are all four major asset categories. So in other words, we don't just focus on gold and silver, for example, or on the stock market. We also look at the bond markets, foreign exchange. And right now, I can pound the table and say, in my experience, I've never seen such connectivity. What one does can impact the other. It's not always that way. And right now, we saw what was going to happen to gold and silver starting in March, April, where they exploded up out of their range-bound situation. But the stock markets are focused right now because it's got some interesting stuff going on that I think will contribute to gold and silver.
And that will make for a very interesting back half of the year, I'm sure. Again, and Michael, I know you do have a service designed specifically for the metals. So if someone is interested in the metals and mining shares, again, olivermsa.com for more details. Michael, we're wrapping up, again, like I said, the first half of the year. This month has been an interesting month, though, with the Fed meeting, some, again, dialing in of rate cut expectations, things like that. What kind of macro things have caught your eye here in June?
Well, first off, I've said this before in some interviews, and I'll say it again. In fact, the Mises Institute, which I've affiliated with somewhat, had a one-pager in the Wall Street Journal a couple of days ago about who needs the Fed. It was like a huge article. It was an intellectual article attacking the notion of a centralized government-run central bank. Anyway, I think in 5 years you won't have a Fed. And the Fed is almost always behind the ball. They create situations with their monetary boom-bust policies, which create quite often stock market boom-bust attributes.
Yeah.
And the last one, though, where they went berserk on QEs for years, created the biggest bull market, quote unquote, in stock market history in the U.S. We went up from about 8-fold advance in the S&P 500 over a span of 12, 13, 14 years, and about a 17-fold increase in the NASDAQ 100. Now, you go back and look at the 1929 bull, or look at the mid-70s bull, or look at the dot-com bull peak, or the real estate peak in 2007. No stock market bull trend matched the duration and the percentage gain. And if you look at money supply growth over the last decade or so compared to prior, it's more. You look at Fed funds rate, effectively zero, except for 2 years of the last dozen, okay. You understand why. Hey, no wonder there's a stock market bubble. They blew air into it. Well, the problem is when the bubbles break, and they always break, the Fed panics. The Fed has to go back the other way, okay, because that's one of their priorities. Remember, unemployment is one of their other mandates. And so as soon as you see the stock market start to break, that's going to yank the Fed back into their normal policy mode because they'll have to panic. The other major central banks like ECB and BOJ, they're already inclined that way. I think ECB's already cut rates. So the whole group will shift back to that again once they get a little prick from the stock market. And I think they're going to get a prick. And I think the bubble's going to exhibit busting behavior, especially in Q3 of this year, I mean, in the next 3 months. Not Q4, the October notion of October crashes in 87 and 29. No, I think if you're going to get some sharp, sudden surprise down, which I don't think will be a surprise to us, but to a lot of folks it will be, you're going to get it in the next 3 months. And we measure the technical factors that might spark that event. And I think they're there. They're very ripe. It won't take much of a sneeze starting next week, next quarter, to start to generate that breakage.
Well, let's go into that in greater detail, if you don't mind, Michael. I know you and I went through this on my TF Metals Report site last week and connected the dots as you see this. And again, I'd ask you to kind of frame this from your momentum perspective, because that's obviously part of your proprietary model and the unique way that you look at the market, just not straight price action, candles on a chart, moving average kind of stuff. Because again, if, like you said, a sharp rollover in the stock market will be the kind of thing that would prompt the Fed to emergency rate cuts, that sort of thing. And that's not priced into the precious metals at this point. So you can see how this trickles down, everyone. Michael, give everybody a little bit of a rundown on this upcoming quarter and some of the concerns you have for stocks.
Well, a lot of analysts know this, and it's bleeding obvious that the market's very narrow, stock market. It's narrower than it's ever been in terms of what's leading the market. And, it's a handful of stocks and one sector out of a dozen that's really doing it. If you look at certain sectors of the stock market, like banking, one we're particularly interested in is commercial real estate, or REITs, ETFs like RWR, VNQ, which don't show the housing market. They show more commercial real estate. That's lame. It's in the middle of its range in the last 3 or 4 years, not anywhere near its high. And there's some other sectors as well. One in particular, consumer discretionary. That used to be a hot leading sector from 2009 through 2022. It led the market. In fact, it outperformed the S&P. You wanted to be long that. Well, at the front end of that ETF, for example, is Amazon. 24% of the entire ETF is Amazon. So you got one of your big fat leaders in the front of that ETF. And yet that ETF, when you look at a chart of that XLY and compare it to like a monthly chart of the S&P, they're in different universes. XLY is not near its high. It looks very anemic. In fact, even with Amazon's leadership, it still looks anemic. Something's wrong there. Normally, XLY is considered a risk-on sector, meaning it's the one you want to be in when you're going up, okay? You take the risk, make the money, okay? And consumer staples, which is opposite to consumer discretionary, that's the day-to-day stuff that consumers have to buy. But consumer discretionary reflects the exuberance of the consumer. Well, how come XLY looks so bad, even on a price chart? Well, so we're watching certain segments of the market, not just the market itself, like the S&P or the NASDAQ 100, for signs of momentum trend breakage. Now, what do we mean by that? There's a lot of momentum indicators out there on your computer screen. RSI, MACD, you push the button, it's free, it's part of your program, They're what we call wet noodle indicators. In fact, they look like noodles, okay? Mm-hmm. Sometimes they're reasonably good, sometimes they're very lagged, sometimes they're meaningless, particularly in a dynamic market where you think you're overbought and they ram it to you for another 4 weeks of overbought. Yeah. Okay. Yeah. And in a normal trading market, they might be okay. But in this environment we're starting to get into, I think referring to that stuff won't work. What we look at are momentum structures. Just like you look at a price chart, you draw a line under multiple lows that are ascending, uptrend line, or a flat floor. That's a structure, okay? We do the same thing with momentum oscillators, which often do not look like the price chart. And so it was the case, for example, and I'm not going to argue we're going to crash in the third quarter. I'm just going to argue there's probably a sharp initial downside in the market. But back then, if you looked at the price action in 1929, August, September, even into early October, and the same thing at 87, And in fact, I caught that one. That's one of the reasons I developed momentum structural analysis. The 87 crash looked absolutely copacetic prior to the crash. As you looked at the price chart and thought, oh, it's just a little pullback, no big deal. When you looked at momentum, you were breaking the bridge over the River Kwai. I mean, you were blowing the structure out, but on price, it was just a little dip. And you suddenly went from a little dip to a 35% crash within a week and a half in late October. And momentum explained it, price didn't. We have similar structures right now set in most of the indices and sectors of the stock market, such that when you go back like to the last pivotal price low, which was in what, October of 2022, that's when the 22 sell-off ended, was in October. You turned up since then. So what are we talking? A year and 3/4 of upside, okay? The S&P's made new highs, NASDAQ 100's made new highs. Some sectors have, many sectors haven't. But you've got a momentum structure that's been built during that time. Not just the price action that you can't define it very well with a good trend line. It's sort of curved. In other words, you can't find a multi-point trend line in most cases on the price charts, but on momentum, you can see a structure that a blind man could feel. Okay, it's just perfectly clear, in your face structure. The problem is when we get into next quarter, those structures are vulnerable for breakage because the numbers underlying the momentum structure, meaning like the 3/4 moving average, is going to move up. Hence, the relationship between current price and the 3/4 average is going to narrow because the mean by which you're measuring is jumping up. And the problem is you can't narrow it much because you're going to break these structures. And one of the areas we're particularly looking at, which most people aren't now, because our Secretary of Treasury Yellen said, "Oh, no problem with commercial real estate. It's quote manageable." Terms that Bernanke used in 2007 about mortgages. Okay.
Right.
When we looked at the commercial real estate market, it has rebounded halfway back to its highs of 2022. Very anemic and sideways, but comfy. It's not breaking down, so it's nobody's scared. The fear has gone away from it, but the structure is right at it. You can't drop a couple percent in that sector starting next quarter, and you're going to blow these structures, in which case all of a sudden, the sleepy, once alarming sector, banks will be related to this as well, starts to break its major trend structures. And so you can watch the few tech leaders all you want to. If that commercial real estate market starts to break and the banks follow, the alarm bells start going off again, especially for the Federal Reserve.
Yeah. Well, if anything, that's an excellent warning for people not to just, selling, man, go away, take the summer off kind of thing. Pay attention. If you're exposed to equities, your 401ks, your self-directed IRA, whatever, you've got general equities in there. Be paying attention and watch these signals as we get into the summertime. Because like Michael said, he's not talking fourth quarter, he's talking third quarter has his concerns. So let's segue that then into a precious metal discussion here in the back half of this podcast. Michael, I know you think they are kind of on the launch pad. This pullback that we're currently in at the end of the second quarter has been productive in a sense. But it has not dampened your enthusiasm. So tell us where you think we are for gold and silver.
Well, first off, in our assessment, the gold bull, we're flexible on gold long term. We primarily look at long-term trends, sometimes intermediate. But we got bearish on gold, for example, in 2012. So, we're fair and balanced, okay? After it peaked at 11, 3 months later, we said, that's it. It never could get back to its high again. It just labored in 2012 and finally crashed in 13. Then in February of 2016, coming up off of its low at 1,050, actually 1,046, at $1,140 in February of 2016, annual momentum said, green light again. Bull trend has begun. Okay, nothing on annual momentum has argued since then that trend is over. It's been ongoing, despite the 3.5 years that gold spent capped off at just above 2,000, and silver in downward staircase and miners in a downward corrective staircase for 3.5 years. That pause did not break the dynamic of the annual momentum positive trend for gold. It just paused it. Okay. The action in March in gold coming up through the price highs, actually. The price was fairly coincidental then. Annual momentum of gold broke out through a secondary structure, saying, okay, the doldrums are over. We're back into a resumed strong mode. One that should be more dynamic, because at the end of prior bull markets, there've been a couple in the last 50 years, where gold's gone up 8-10-fold in a matter of 10 years, mid-1970s to 1980, 2000 to 2011. Okay. Well, if we went up the same dimensions that we went up back then, gold would be $8,000-$9,000, an 8-fold move. I mean, those moves are 8 and 10-fold moves. Okay. But usually most of that move occurs in the last year of the bull trend. Most of the dynamics occurs then, where it suddenly unleashes. And right now we argue you've got the fundamental and technical background that gold has never had before, the dynamics of which should drive it, should explain why that kind of dynamics will unfold. Yes, we've paused. Okay, now gold made a high in April, above 2,400. Gold made a high in May, above 2,400. Gold's high this month, just above 2,400. So you had 3 months in a row up there with highs within 1% or so of each other. Hardly a dynamic top, you know what I mean? A spike top. Like in summer 2020, when you hit your high, you dropped. 2011, when you hit your high, you dropped. You didn't come back to it again. Okay. So we're getting really a lateral movement in gold. Right now, as we do the interview goals like 2310. Okay, so it's 3-4% off. It's the 2,400 level. It's just a sideways, boring looking thing. Silver, meanwhile, did something different. Now, right now, it looks like silver's had a deeper pullback than gold. Yeah, over the last 4 or 5 weeks, it has, since the May high. But silver in May vastly took out its April high, unlike gold, which plateaued. Okay, silver went on further. We suspect, based on shorter-term momentum trend dynamics, that this pullback you're getting right now in silver, and as we're speaking, it's down under 29, okay? It was under 29 a week or so ago as well. We think you're probably very near the low, if not at the low, and it won't take like a $1 upturn from current price levels to really explode it up out of the hole again. You don't have to go back to 32.5 to make the point. You get up around the upper 29s next week, you're going to resurge. It's going to resurge again. So we've got some charts that show that point there. But when you look at like the daily action of gold since, let's say, April or May, you see this sort of sideways on momentum. You see a very clear multi-point downtrend structure, something that if you break out above is a buy signal. You can't find that line on the price charts. Price charts are sloppy. So the price charts leave you confused. You know, where is it resuming? You know, momentum says, you know, about next week, probably about $40 above where you're trading right now, you're going to break out again, resume. Okay. Silver has a similar pattern, except this has a downtrend line. It's fairly steep. It already broke out above it, but it's developed what looks like, if you look at the momentum chart, not the price chart, you'll see what most chartists would say, oh, that's a head and shoulder bottom. You've defined the neckline such that you get through that neckline on momentum now. I'm talking weekly momentum plotted in daily bar format. Next week, somewhere about, like I said, $1 above where you are now, we're just below 29. You get in the upper 29s estimated. You're going to blow that head and shoulder neckline out, and you're going to restart silver. So we think we're close to the end of the congestive pullback, and we'll resume the acceleration phase. What is likely to help spark that resumption? Watch the stock market.
Right.
Yeah.
You can see where those dots connect, no doubt about it.
Yeah.
And as we get into the next quarter, I would just ask you one last kind of a traditional TA sense. You know, I was noting on my site last week, you know, we watched the longer term charts, not only monthly, but quarterly charts. You know, and gold began to break out on the quarterly chart at the end of last year, and then really surged at the first quarter, and now is going to have another higher high in the second quarter. Silver might be doing that exact same thing on a quarterly. I mean, it could print its highest quarterly close in like 12 years, Michael. So
yeah,
kind of you would think some of the more institutional money that might notice that sort of thing too.
Yeah, and even when I suggest to everybody that punch up a monthly close only chart, where it's just the close of the month, Go back, 10 years on gold and look at what's happened. And look at the action, the last three bars, three dots, three closes. With today's action, let's say being the end of this week being the end of the month. Okay. And it's a yawn. It's not a dynamic top. It's just, I'm up here, I've gone to sleep for 3 months.
Yep.
It's not the way you top gold. Okay. And you look at silver. Yeah, back in 2020 and early 2021, it traded over 30. But its peak weekly closes and monthly closes were nowhere near that.
Mm-mm.
In fact, they were down closer in the high 28s. Okay.
Right.
Now you look at a monthly silver connected dot monthly close only chart, and you see we're up in the 30, just above 30 last month. Now we're, let's get either side of 29 right now. And look at that in context of that last 3.5 years of action. And you see how insignificant really what we've seen over the last few weeks is in terms of, is it over? No, it paused. Okay.
Well, I think that's a great summation of where we are, my friend. And for everybody who's been watching, yeah, don't go to sleep. Don't just go to the beach and check out over the next couple of months. This looks like we're entering into a rather dynamic period, politically, geopolitically, and with the markets. And those things all connect too. So please keep an eye on things as we head into the back half of the year, everyone. We'll have a full month again of information from Sprott Money. You can be reminded every time they post something by signing up at Sprott Money. You'll get notified there. You can also just like or subscribe, whatever channel you're watching all of these podcasts on. So you get a notification too, because it's going to be another busy month of content here from Sprott Money too. But for now, it's time to wrap up the first half of the year. Michael Oliver, olivermsa.com. Thank you so much for sharing all this information with us. It is very, very helpful.
Thank you, Craig.
And from all of us here at Sprott Money, sprottmoney.com, thank you for watching. We will have another one of these monthly wrap-ups for you at the end of July. But before then, we have the monthly precious metals projections, articles along the way, Ask the Expert, everything else that you can imagine. And we will have that for you starting all again in July. Have a great rest of your week, great summer, and we'll see you again in July.